Welcome back. Thanks for watching. This is Anthony, Parent, and today we look at tax deductions versus tax credits. You know, if something is to be done in this country, chances are it will involve the tax code. Now, what do I mean? Well, if we want more people to use public transportation, we don't make driving a car illegal. We make it expensive with punitive taxes. And then we create steep discounts and give huge incentives to public transportation via tax subsidies. And voila, now we have public transportation few people actually want, but boy does it make for great press releases and complicated tax returns. This type of approach is so American. We don't seem to be able to do anything directly, but rather are obsessed with the passive-aggressive machinations of the tax code, which could be the primary explanation why the income tax is such a mess. Americans fully demand it. Now, in order to execute this delightful tyranny over everyone's life, the primary tools the tax code uses are tax deductions and tax credits. So now what's the difference? And which one is better? Now, before we answer this question, we need to understand how we are taxed. Now, there are exceptions to every rule, but generally you list your gross income, then you subtract out your deductions. From there, we get close to calculating the taxable income on which some tax rate could be applied. There are two types of deductions, and their name comes from where you will find them on a tax return. There are above-the-line deductions and below-the-line deductions. So let's talk about your above-the-line deductions. Your adjusted gross income, or AGI, is the amount listed on your bottom line of page 1 of your tax return. It includes all of your total income, including wages, business, rental income, capital gains, unemployment income, and so on. These adjustments include items such as traditional IRA contributions, moving and education expenses, alimony payments, and deductible portion of self-employment tax. Above-the-line deductions can also refer to a business's deductions and losses. For example, a business expense reduces your net business income, which therefore reduces your total income. Every dollar that reduces your AGI not only reduces your taxable income, but it also may help you qualify for other deductions as well. Now, various tax credits become limited by your AGI. In tax speak, we say they are phasing out. In some cases, a deduction may help you qualify for a credit or other tax perk that you wouldn't receive otherwise. That is, in order to get some credits, your income needs to be below a certain threshold, and a deduction may do that. Now, here's a simplified example on how tax credits work. What's worth more, a $10,000 tax deduction or a $10,000 tax credit? If you could take it, usually the tax credit is a better deal. Here's an example. Suppose you had an income of $100,000 and a tax rate of 20%. A $10,000 deduction will reduce your income to $90,000, so you'll owe $18,000 in taxes. Now, if you had a tax credit and no deduction, let's assume the same 20% tax rate. The $100,000 now becomes $20,000 in taxes. So your taxes have gone up, yet the difference now is you have a $10,000 tax credit to apply. This reduces your $20,000 tax bill to $10,000. So you lost a deduction, but yet you paid less in taxes. So you see how easy it is to hide these games. Congress loves being coy and be able to hide the truth from you, because if you knew the truth, you'd probably be looking for another Congress. And talk about hidden taxes, watch our video on how Congress hides the true cost of employment taxes from you. Provide the link in the comments below. Now, some credits you need income to offset, while others you don't. The kind of credits you need income to offset, again, are called non-refundable credits. A non-refundable tax credit is a tax credit that only can reduce your liability to zero. Here are some examples of non-refundable tax credits. Now let's talk about refundable credits. Unlike a non-refundable credit, which usually will not result in a refund, a refundable credit will continue to lower your taxability beyond zero so that a refund becomes possible. Here are some examples of refundable credits. So let's talk about below-the-line deductions. I mentioned above-the-line deductions, but there are also below-the-line deductions. So how do they work? Well, here's an example. Schedule A is where you itemize your deductions if you decide to itemize your personal deductions. Now, everything is fine as long as your income stays low. But as your income rises, certain deductions become less and less valuable. Again, this is called a phase-out. A phase-out can destroy your below-the-line deductions. Below-the-line deductions are subject to the most restrictions, meaning depending on your income, it could be as if you didn't have the deduction at all. This happens most often because of people writing the tax code felt you made too much money this year. So not only do they want to hit you with a higher marginal tax rate, They also want to have you a higher effective tax rate due to the fact that deductions other people get, you do not. Isn't that great? The people who demand your money year after year after year say you have plenty of it. So it must be true, right? To sum up, tax credits are generally better than refundable tax credit rather than non-refundable tax credits. Tax deductions usually don't give you the punch of a tax credit, but at least we know that above the line deductions are better and have fewer restrictions than below the line deductions. So what do you think of all of this? Do you think we should simplify the tax code, or do you think we should be adding more tax credits and deductions? Now, if you liked this information in this video, please like and share it. And remember to hit the subscribe button and hit the bell if you want notifications. Again, this is Anthony Parent of IRS Medic. Thank you for watching.